freedom.com. It's a blog about where we talk about the things that allow us to obtain freedom in our health, wealth, and relationships. And Bitcoin is one of the new technologies that's coming out that's going to allow many people on the planet to have freedom in their finances. So we will talk a lot about Bitcoin here at prisonerfreedom.com. In this third episode of currency analysis, I want to talk about how to choose the best time frames for Bitcoin and Forex markets. I get this question a lot about what time frames that you should be using. Should you look at daily charts, weekly charts, monthly charts, 5-minute charts, 1-minute charts? So I'm going to update my charts here for the Bitcoin and then the Euro and things like that. And along the way, I'm going to talk about how to select the best, I wouldn't say the best, but the ideal time frames for your particular style of trading. Okay, so let's go ahead and get started. Here in front of me, I have the tradingview.com site. I like to use this simply because it's very, very user-friendly. It's one of the most user-friendly platforms that I've seen for technical analysis. So, excuse me. Okay, let's go ahead and get started. Here is the chart from the other day, from the second currency analysis, number 2, episode 2. And let's go ahead and take a look at this and update it. You'll notice that since we put in those support and resistance lines right here, price has not come down to it. So you will notice that, let's go ahead and zoom into the 1 hour chart here real quick. When you get here, notice how price is being compressed like that. The best way I found to fix that is just click on the reset chart, and it brings it back to the quote-unquote normal size that it's supposed to be. Okay, the way that you determine the time frames that you use is based on the two things. One is the size of your trading account, and number 2 is the amount of trading experience that you have. So let me do an example here for you guys real quick. If you guys are trading right on this right here, notice that this channel that I drew in right here, this downward hourly 60-minute channel, all right, you'll notice that the width of this channel, and the way that you measure the width of any channel is through its vertical, through the vertical distance. Okay, so we come down here and let's use this price range right here, and if we just go from, let's say, from here, from the top of that down to here to the bottom of this channel, we have like a $500 range. Okay, notice that it says minus 494. So it's pretty much a 500. We can just round it off to a $500 range. Okay, and what that means is that if the channel here has a $500 vibration, meaning that it'll vibrate back and forth between $500, and you have to ask yourself, can you handle that? Can your trading account handle a $500 swing? Okay, so if you are looking to take a risk, okay, if you are a beginner, right? Let's say that you are a beginning trader and an intermediate trader and a advanced trader. Okay, so a beginning trader would want to use somewhere around 1/10 of 1%. So that would be right there. That would be 1/10 of 1%. A intermediate trader will use somewhere around a 3/10 of 1%, and then an advanced trader can use anywhere between 0.05, half of 1%, to 1%. Okay, right there. I personally do not recommend going over more than half of 1%. Okay, so just keep that in mind. Basically, if you have a, let's just say, for example, that you have a $1,000 trading account and a $10,000 trading account and a $100,000 trading account. That means that if you had a $1,000 trading account and you could not risk more than 1%, I mean 1/10 of 1%, right? Let's just say that this equals this times this right here. That means that you don't risk more than $10. You know, something ain't right here. Oh, the math ain't right because this ain't right. Right there. That's what it should look like. Okay, so if you're a beginner and you have a $1,000 trading account, you probably don't want to risk more than one. Oh man, why is that not working here? Okay, you guys know how to do it. You guys can figure out the math here by yourself. Okay, what I do is just take this, multiply by that to get this. Okay, so I'm not going to waste your time here doing the rest of this, but for a beginner, you really don't want to spend more than $1 for a stop loss. Okay, if you have a $10,000 account, no more than $10 for a stop loss. A $100,000 account, trading account, you don't want to risk more than $100 on a stop loss. Actually, when you're a beginning trader, there's no reason for you to be trading this size account anyway. Okay, the most that you would trade is probably something like that. So don't do this and lose $100. Keep this in mind, guys, that when you're trading, in the first, I would say 6 to 12 months of your trading career, that's where you're going to lose the most money. Okay, and that's what I call a market tuition. You have to pay a price to learn how to trade. There's no getting around it. Nobody learns how to trade and become profitable for free. Okay, if anybody tells you that they don't lose any money to trade, they're probably lying to you. Whenever I talk to another trader, I always like to get an idea how much their market tuition is. So when I talk to another trader, I will ask them, hey, you know, how much did you lose to learn how to trade? You know, for me personally, I lost close to $40,000 to learn how to trade. When another trader tells me that they only lost $100 to learn how to trade, I don't believe that. I don't believe that you've made enough mistakes by losing $100 to have learned how to trade successfully. Okay, at least I haven't met all the traders that I have met that trade stocks and Forex. Bitcoin is new, so I don't know how much you have to lose to learn how to trade that. But in stocks, Forex, and futures markets, most people that I've met that have learned to trade consistently profitable and trade successfully, they've usually lost quite a bit. It's usually more than $10,000. All the people I've met have lost like 20, 30, 50, 100, $200,000 before they learn how to trade well. Okay, so if somebody tells you they only lost $1,000 or something and now they're a good trader, I never believe anything like that. I never believe anything like that. Even the guys at Goldman Sachs or the guys at Bear Stearns or Lehman Brothers or any of these big institutions where they have somebody over your shoulders and monitoring what you're doing and making sure that you do it right, even those guys that's in a controlled environment where you're not even able, you're not even capable of, there's no way for you to lose more than what the institution allows you to lose, even those guys lose more than $1,000 or $10,000 before they learn how to trade. So for someone to say that they learn how to trade for $100 or $200 or $1,000, to me that's just a bunch of BS. Okay, so excuse me. Okay, so now that we know how much we're capable of losing, right? Then we have to monitor this and look at the swings in price. So if this channel here this hour channel has a $500 swing, well, obviously, if you have a $1,000 trading account, you're not going to be able to withstand a $500 vibration. Okay, if you have a $10,000 account, even though you can withstand the $500 swings back and forth, it still does not make sense because you're only allowed to lose $10 on each trade. Okay, so on a $100,000 account, even then it's still kind of tough. All right, there's ways that you can reduce the position size to where you can manage this $500 swing. But on something, if you only have $1,000 or $5,000 trading account, then this time frame, this 60-minute time frame, is not for you, because the risk that you have to incur is way too much. Okay, so now let's go ahead and let me see if I can move this over here. Let's go ahead and move down to, let's cut this time frame in half and see what happens. Okay, if we cut this time frame in half, right, now we see that the trend is a lot different. Let's just pick a random channel here. Let's say that you were trading between this and this right here. Okay, now let's measure the swing, the vibration. Okay, or some people, scientifically, I think you call it the frequency. Okay, let's check out the frequency of this. So on this, now it's reduced down to $134. Okay, so now let's look at our risk management or money management chart again right here. Okay, so now these two people right here, the one that owns the $10,000 trading account and the $100,000 trading account, it fits within them. And then the $1,000 trading account, it just depends upon the position size that you trade. If you trade one Bitcoin, obviously that's not gonna work for you. If you trade like 1 or 2 millibits or maybe a few satoshis or something, then you can get away with it. Okay, so that's how we look at it. Let's go ahead and take a look at the 15 minutes. Let's cut the time frame in half again. Okay, so now if we take the time frame here and we draw this time frame here, right, this trend here, notice how the depth, okay, the height of it gets reduced. Okay, so when we measure this, now it's down to about $97. You can round that off to $100. So now the width of this channel is $100. Then now you have to ask yourself, is that $100 channel, does that fall within my trading account size? That's easy for a $10,000 trading account or a $100,000 trading account. If you have a $1,000 trading account, it's still tough. It's still tough to sit there and watch your account swing in your favor by 10% and then swing against you by 10%. So that's why the time frames are important based on your account size. Now, let me go ahead and say this, okay? Number one is the account size determines the time frame that you use. Number two determination is your trading experience. Okay. Now let me give you guys a few examples here. Okay. When I was just starting out, okay, when I was just starting out as a beginning trader, okay, I could only withstand, okay, I was only able to withstand a very small swing in price. Okay, so on this chart right here, we have 3 different price swings. We have this big channel here where price swings $500, and then we have this smaller channel, this medium-sized channel that swings $135, $134, and then we have this one that swings $100. Okay, when I first started trading as a beginner back in 2008. I started in March of 2008 was when I made my first live trade. Okay, excuse me. At that time, my job was I was getting paid about let me see, I was getting paid about $75 to $100 a day. Okay, let me just put my income here. Okay. And okay, so as a beginner back then, I was making anywhere between $75 to $100 a day. So whenever I made a trade and I lost $75, it hurt me tremendously. Okay, it hurt me a lot emotionally, and it really messed up my mind because it was tough to sit there and know that I had to do 8-9 hours of labor each day, and then here in my trading I would lose that in 5 or 10 minutes. So that hurt a lot. Okay, and it really did. It really hurt me quite a bit to do that. And so that's tough to do when you make $75 to $100 a day in US dollars, and you make a trade and lose $50 or $75 or $100 in 5 to 10 minutes or even an hour. Okay, because then you look at how much you lose compared to how much you make at your job, and you wonder if this is worth doing or not. Okay, so at that time I had to reduce I'm just going to put here my loss limit. Okay, so at that time I had to manage my losses so that it's within an emotional reason to me, so which is no less than $20. Okay, I try to keep all my losses less than $20 in the stock market. That means that I was only trading like 10 shares, 20 shares, 50 shares at most. Okay, I did not even trade 100 shares at that time because emotionally and financially that was way too much for what I could afford at that time. Okay, now the next thing was that when I started to move up in 2008, 2009, somewhere in the middle of 2009 and then beginning of 2010 was when I was able to make a little bit more money. Okay, I was making anywhere between $100 to $200 a day, and at that point I was able to mentally, okay, lose less than $100, meaning that if I made a trade and I lost $50, it was okay. It was okay for me because I knew that I made enough at my job to not be homeless or not have food. Okay, so at that point I was able to move up to a bigger time frame. The bigger time frames allows me to have a bigger reward, but at the same time it allows me to have bigger risk as well. So when I went from like a 1 minute chart to a 3 minute chart to a 5 minute chart to a 15 minute chart, yes, now I can afford to lose $100 on one trade, but at the same time I was able to make $300, $400, $500 on a trade also. Okay, whereas in the past when I was trading on a 1 minute or a 3 minute time frame, it was not I never made a $500 gain trading a 1 minute chart. Okay, not in the stocks and the Forex market. So now I consider myself to be right now a pretty much an advanced trader, and now my income is at a higher level. Okay, so my income is anywhere between, you know, 200 to 400 a day. So and this is from my from all my job, my multiple streams of incomes, my websites. I got a bunch of stuff that I'm doing, okay, from my trading. So because of that, now I can afford, right, a $500 plus swing, meaning that if a trade swings $500 against me or in my favor, I don't flinch on it. It doesn't bother me one bit. Okay, so that's like the minimum. Okay, I should even put this right here. Hold on. I should put this. So now I can handle a greater than $500 loss limit. Okay, because of my account size, because of my trading experience, and because emotionally, okay, when I say trading experience right here, what I mean by that is emotion. Okay, that's what I mean. Now I'm going to give you guys an example. Okay, for me, for the price to swing, I've had trades I've made where it has a let me see, it has a $2, $3, $4,000 price swing before, and it does not bother me one bit. Okay. Now, obviously, if you only trade a $1,000 or $10,000 trading account, then obviously that's going to be a huge emotional swing for you to see your account go against you by $2,000 or $3,000. Okay. So, excuse me. So obviously, when you feel that emotional pain, you should not be trading something that big. Okay. No matter how greedy you are, you should not be trading something that big. Now, I have a friend who we are no longer friends because he has a habit of, he's a very rich guy. He comes from a very diplomatic family, so he has some old money. And he and I stopped being friends after I caught him a few times messing with other guys' wives. That's something that I do not tolerate in my life. I don't believe that you should go and try to mess with somebody else's wife or girlfriend or fiance. I think that there's a lot of single women out there in the world, and there's no need to go and mess with somebody else's women. Okay, and I caught him doing that twice, and after the second time, I fired him as my friend. Okay, now this this former friend of mine, because he had more money than I did, he would normally every time he made a trade, the price would swing a bunch of money. Okay, $5,000. That did not bother. He did not even flinch one bit if the price fluctuated $5,000 one way or the other, 10,000. It did not bother him one bit. Okay. Then I have another trader who's a lot older. He's in his 60s, and he trades a multi-$100,000 account. I think it was like $200,000 or $300,000. And for him, if the price, he was a position trader, and if the price swung $10,000 either way for him each day, that did not bother him one bit, because he has been trading for a long time, and to handle a $10,000 swing was no problem for him emotionally. Now, for some people, that could be a huge problem, especially if you're a beginning trader. You're not going to be able to sit there through a $10,000 swing, okay? Where the price moves against you or in your favor by $10,000, it's not going to be easy. So you're going to have to trade a smaller time frame or trade a smaller position size for a bigger time frame, okay? So in other words, you might trade only 1 millibit on the hourly charts, but then trade 10 or 20 or 30 millibits on the smaller time frames. Okay, so you have to balance whichever one that's more emotionally that you can handle emotionally and mentally. Okay, then I have also another friend who is a businessman, and he does not spend a lot of time trading. He spends more time in his business because he makes way more money in his business than he does in trading. However, the money that he makes from his business, he has to do something with it. So he just can't let it just sit there doing nothing and earn 0.1% interest in America. So he puts it into the stock market and he trades it. And on his long-term position trades on his stocks, the price can swing $70,000 or $100,000 a day on him, and he handles that with no problem. Now, obviously, if he's letting his account swing by $100,000 against him or in his favor, then he must be trading a multi-million-dollar account. And yes, he is trading a multi-million-dollar account. So for him to handle a $100,000 price swing either way, that's not a big deal to him. But he's been doing that for a long time. All these guys that I'm talking about that have that handle a $10,000 price swing or more, they're usually in their 60s and 70s. They've been trading for a very long time, so they have conditioned themselves mentally to withstand the price swing. Okay, I consider myself in the late intermediate stage of trading and the early advanced stages of trading, like somewhere in between here, because mentally, I'm still not able to handle a $10,000 price swing yet. Okay, even though I can afford it. So I'm not able to handle that. So that's why I don't consider myself like a very, very advanced trader. I know many traders that can handle a $50,000 or $100,000 price swing based on the account size that they're trading. They trade very large accounts. And even if you give me $1 million right now, I still would not be able to handle a $10,000 price swing. So I'm relegated to trading on the time frames that I am based on my emotional trading experience, okay? And I see that I'm 42 right now, and I can see myself by the time I get to 50 years old that I can handle a $10,000 or $50,000 price swing, okay? So that's not going to be a problem, okay? Right now, if I could handle a $10,000 or $50,000 price swing, I could very easily go and get more money from investors to trade. I don't do that because just mentally I'm not able to handle it at this point in my trading career. Okay, so I hope that makes some sense. Okay, when it comes to selecting the right time frame for your trading, let's go back here to the 1 hour again and take a look at what the market has been doing. I'm going to delete these right here real quick, guys. My support and resistance lines are going to remain the same. Now, nothing has changed. Let me move out to a 3 hour time frame here real quick so that we can see bigger candles here. If you guys will notice here, okay, let me get rid of this vertical measuring tool here. Okay, let's take a look at the price action here, guys. You know that if you've been following me for any period of time, you know that I do not like to use indicators and stuff simply because they lag. Anything that I need to know about what the market's doing is right here reflected in the price charts on the candlesticks, okay? So let's take a look here. I think the last time that we talked in episode 2, we were somewhere in this area here. Price has fallen since then, okay? Price has fallen since then. But notice how when price fell, it stopped right here, okay? It stopped right. Let me use this. Notice how price stopped right here, okay? In this support area. See where price fell and it came up and it tested this area right here and it fell again and then it shot up through and then now it's retesting that same area right there. Notice when we talk about trading price action, what we're doing is we're looking at what the price is doing. Notice how when price came down here, it shot back up to here, and then it tried to set lower lows, but it couldn't. The buyers came in and pushed the price back up to here. Notice this low right here. I'm going to zoom in right here so you guys can see it. Notice how this low was not able to go lower. Notice how price could not go lower than what it previously did. That means that the bulls were coming in, the buyers were coming in and buying the price back up, buying this back up to here. And then when it came back down, right, it tried to retest this area here, and then the buyers bought it back up again. And every time it came down to here, the buyers would buy it up. Down here, somebody would step in and buy it, okay? So right now, short-term wise, there are a lot of buyers here at this area and why are people buying here, okay? Why are people buying here? If the market has been falling, why would someone step in to buy at the low 600s here? Well, there's many reasons. One reason is that they missed it. They missed the move. You know, there's a lot of people that missed the move on the way up, on the run up, and they've been sitting there and they've been waiting and waiting and waiting to have an opportunity. And the people who missed it over here, they're saying to themselves mentally that, hey, if price ever comes down to 600, I'm going to buy in. If price ever comes down to 600, I'll buy in. So that's what it did. It came down near 600, and they jumped on it and buy in. Okay, we don't have to know the reason why they buy. The buyers had it in their mind that when the price comes to this level, they're going to buy. Okay. The other reason that we have here is, remember, the people who shorted here are taking profits. The people who shorted here, who did not take profits here, see prices going up and now it's going sideways and they get tired of waiting. So now they finally, cover their short positions and buy out. Okay. So that's it, guys. I don't have much else to update. My support and resistance lines are still where they are at because price has not come down and broken it or anything. So there's nothing that I see. If let's just take a look at this real quick. Like I always say, there's three things that price can do. It can either go up, it can either go down, right? Or it can go sideways. And right now it seems like it's going sideways. So if we're looking to take a long position on this, remember that we have this green trend line right here is the long-term daily trend. If we're looking to take a intermediate or long-term long position, I would wait until price breaks the high of this right here. It would have to break the high of this right here. In other words, I would wait until it's above this area right here before I take it long. So that would make it above somewhere around 775. Okay, above it would have to break above that and come up before I take it long. And if I take it long right there, I would put my stop somewhere below here. Okay, if let's say that price goes up from here and it continues to go up, I would put my stop somewhere here if I was if I wanted a tight stop, or no more than here, no more than below this. Like if price comes up to here, you took it long and it was to come back down and then break the low of this area right here, I would definitely get out. That long is long gone. Okay, so if you were looking to take this short, on the other hand, okay, then coming up here when it hits this trend line right here, that's where you would take it short. If price goes sideways and it hits here, boom, your short would be right there. If price happens to come up to here, right, then you would take it short here, and your stop would be above this red resistance area. Your stop would be up here, regardless if you go short here or if you go short here. Okay, now you need to make that decision ahead of time before price gets there. See, if I make up my mind that I'm going to go short when it hits this trend line, I'm going to go short and put my stop above here, regardless of what the market is doing at that time. Okay, I'm not going to make up my mind and say that I'm going to go short at this trend line, and then when price gets here, I hesitate, and I see people on this chat roll right here making their opinions and all that. That's not the time to make a decision to get in or out of a trade. That is not a good time at all. The time right now, I think that Abraham Lincoln, one of the greatest presidents in America, I think he said that that if he had 8 or 9 hours to chop down a tree, he would spend the bulk of that time sharpening the axe. And then in China, we had Confucius say that the time to sharpen the axe is before you go into the woods. Well, before the time to decide whether to get in or out of a trade is before it happens. While the market is going sideways and the market is calm, that's when you make a decision when to get into the trade, because that's when your emotions are not spiked. Your emotions are at a neutral point. Okay, it's not up, right? Let me say this. Let me demonstrate to you guys what I'm talking about. Okay, when here is your flat line right here, your emotions. You never want to make a decision in your trading when it's down. Like when you're depressed, you break up with a girlfriend, you have a death in the family, anything like that. When it's down here, you never ever want to make a decision on your trades. At the same time, when your emotions are positive up here, let's say that you just met a new girl and you got a date with Britney Spears or whatever, right? You win the lottery. Never ever make a decision, okay, when your emotions are up here or when your emotions are down here. The time to make a decision is when your emotions are flatline. Okay? When you have, it's neutral. This is what I call neutral right here. This is what I call positive emotion, and this is what I call a negative emotion. Never, ever, ever make a decision to get in or out of a trade when your emotions are negative, and never, ever make a decision to trade when your emotions are positive. You make it when your emotions are neutral, okay? So right now, while you have no trades on, the market is going sideways, that's when you make a decision, okay? So this is, let me just go through the thought process with you, okay? So I'm going to go short here, and let me just make a right there. So my goal is to go short there, and my stop loss is up here, okay? And my exit, my first profit target is down here. And now I'm doing this real quick, guys, just so you guys see the thought process of a trader, okay? So there would be my second profit target down here, probably right somewhere right here, okay? So I take it short right here, enter where the green line is at, my stop loss is up here, my first profit target is here, okay? Either take some off the table or move my stops, and then second profit target is here. Now, if I take a measurement before I take that trade, it has to make sense to me. Does this trade make sense to me, profit-wise? That means I'm going to risk that much. Remember, guys, I don't like crunching numbers. I'm a art teacher, so I like to be visual, okay? So when I take a look at this, I ask myself, is there enough potential reward here for the amount of risk that I take? The red box represents the amount of risk that I have to incur, and the green box represents the amount of gains, the reward that I have that's available, okay? So now, if I hit here, then that's my reward. If it comes down to here, the reward's even greater, okay? So at the first target, there is enough to where it can warrant me taking it. In other words, there's enough profit here, there's enough reward potential. Remember, trading is all about probability and potential. There's enough potential here that, okay, it's worth it, okay? Now, on the other hand, if I decide that, you know what, I'm long-term, I'm bullish on Bitcoin because of its profound technology, okay, then what I would do is I would take it long after it broke the high of this right here, just right above it. I would take it long, okay, and then I would set my stop. It's either going to be, see this, the red part right here? It's going to go sideways and then it's going to come up. I would put my stop right below that. I would put my stop right below that area, okay? So my first exit would be like somewhere like right here. And then I would enter where the green line is at, my stop loss is here, and then my potential reward will be here, and my second potential reward would be here, okay? Now, if we take a look at this, you'll notice that, hey, wait a minute, the amount of reward that's available, okay, is not that significantly greater than the risk that I'm taking here, okay? So that means that when price comes up above here, it's going to hit here, and it's going to bounce around, and then it's going to shoot back up. That means that in order for me to take this long trade, there's two things I have to do. Either I have to reduce the size of my position, meaning that instead of trading one Bitcoin, I might cut it down to trading just 1 millibit, okay, or 1 centibit. Either way, you have to do the math, okay, so that the risk is a lot less, okay. Then the second profit target would be up to here, okay. For sure, when price comes up to here, even before it reaches new highs, it has to fight through this resistance level before it can go up to newer highs. So there's no point in sitting through that if you're a short-term trader. You might as well take profits here, wait until the battle between the buyers and sellers are done, and then when it retests and it shoots back up, that's when you would get back in. Okay, so those are the thought process that you have to go through, or in some form or fashion, before you take a trade. Okay, and you do that right now while the market is calm. You don't do that when the market is jumping. Here's a good warning here. You see this chat roll right here? See how it's not moving? When this chat roll is not moving, that's when you make a decision to enter or exit the market. When that chat roll is moving at 100 miles an hour, that is not the best time to make a decision to get in or out of a trade. Whenever I watch the chat roll here and I see guys talking about should I get in or should I get out, that lets me know immediately that they are amateur traders. They are nervous novices, okay? Because a professional trader, an experienced trader, never ever makes a decision to get in or out when his emotions are down here, okay? When his emotions are down here in the negative zone and up here in the positive zone. A good trader makes the decision to trade when his emotions are neutral and flatline. And I will go ahead and end this episode here. And hope that this has helped you guys quite a bit. Below, one of the guys, Fabrice, on TradingView chat right here, he suggested that I put up a Bitcoin donation address at the bottom of the video so that people can donate to it. So I went ahead and put a donation address down here at the bottom of this video. If you want to donate to me, for making these videos, I would greatly appreciate that. Any amount is okay. What's more important to me is when people donate to it. That's just feedback to me that you guys want to see more of these videos. Okay, to me that's what I use it for. I don't necessarily use donations to get rich off of it. I have other streams of income. But even if you send just one Satoshi or 1 millibit, that just lets me the number of people that make the contributions and donations is what's important, because then that lets me know there's actually people out there that watch these videos and benefit from it, and that will encourage me to make more of them. There's no point in making videos if nobody watches it and nobody benefits from it. Okay, and when you do make a donation, in the Bitcoin message box, I think you can include a message in there. Let me know your comments. Let me know what you want to see. Okay. The reason why I made this about the time frames is because when I was on the TradingView chat, I noticed that was a very, very common question that I get asked all the time, is what time frames to use. And this applies to the euro as well, guys. Many of you guys know that I trade the currencies also. I do more trading in the Forex market than I do in the cryptocurrency market, meaning that I do more short-term trading in the Forex market than I do. I take more intermediate and long-term trades in the cryptocurrency market, simply because there's so many disadvantages in trading the cryptocurrencies that I want to make sure that I understand what's going on before I start making more and more trades with it. Okay, so I hope that this, like I said, I hope that this video has helped you guys out, and let me know what your thoughts are. Let me know if there's anything that I missed about answering about time frames. Leave it in the comments below, either on my YouTube channel or on the prisonorfreedom.com blog, and I'll see you guys in the next episode.